2021 is starting to be quite an interesting year as far as like financial literacy is concerned. I guess that makes sense off the back of 2020, where we had like rising stock market prices literally everywhere. Like literally everything was up last year in 2020. Housing prices were way up last year in 2020. And this is off the back of a global recession, of course, caused by the global pandemic. So like things are very strange last year. But despite, the difficulties, we saw a lot of increase in house prices, stock market prices. Like everything was just kind of up. And because of that turbulence, I think a lot of people are a bit more aware right now of their finances, financial literacy, personal finance investing, things like that. But one topic that I don't really see discussed much, I don't really see discussed at all within my community, which is I think is important for people of my age and other students, is their credit score. So this video, I'm going to talk quite briefly about how to improve your credit score, what a credit score actually is, and then why I think it's important to, again, try and improve that, not just now, but also in the long term for the future. But before I go specifically into any technical details, I kind of want to talk about the actual benefits first of having a good credit report, because so many people, as I just said, the discussion's kind of gone amiss. People my age don't even care about not even having a good report. They don't care about having a credit report at all. They haven't actually looked at anything. So let me just talk about the actual benefits of having a good credit score, and then we'll talk more technically about how to improve that later on. So the number one benefit that I've already put out a video in the past, or recently even, about the best credit cards you can get as a student. But having access to good credit cards, good loans, good finances are so key, not just in the future, but also now, because a good credit card, I talked about it in that video, but just briefly to go over it again, you can get good rewards, be it cashback, be it insurance, be it warranty, consumer protection. There are so many benefits having a credit card, not even a credit score, but having a good credit card can benefit you in so many ways. Like I know people that have American Express cards, Amex, where every time they spend, you get air miles. And if you rack up so many air miles, you can just fly around and go on holiday for free. Just because you've been spending on this card, now you can fly out for free. Don't even worry about anything else. It's just like, oh, you've been spending money on Amex? Okay, cool. Here's a flight to the Maldives. Screw it. Let's just go. And if that on its own isn't a good enough incentive for you guys, like think about it like this. I just said 10 grand can get you like a bunch of points. But if you're paying rent in student halls, most of the time you're paying like between 80 and like £150 a month, a week, sorry, which is like what? It's a lot of money per year. It's basically what I'm trying to say. You can probably spend about 6 to 7 grand a year on accommodation if you're in a more luxury place. If not more, I've seen places up to like 12 grand a year. That could all just go straight back into a flight. Like you're gonna pay for that rent anyway. Stick it on your card, and then now you're in the Maldives. But anyway, that's yeah. Check that video out if you want to know more about credit cards. The other benefit, the big benefit to me at least as well, is lower interest rates. Now, that doesn't mean much to us now at this age, but when, once you start graduating and, 1, 2, 3 years time, you start getting that first house, you're looking at mortgages, if you're maybe renting, maybe your first car, trying to get on finance, maybe you want to get the latest iPhone using Apple finance plan. Well, to be fair, Apple's 0% finance anyway, but, a car, mortgage, all these other things, all these other loans, home improvements, you want to help your mom or your dad by rebuilding the kitchen or fixing your garden, whatever. All this stuff costs money, and every time you get a loan or a finance or a credit card, you're going to be charged interest. But the higher your report is, like what your credit score actually indicates to people, or to banks more specifically, is like this person is out of 1,000. How responsible is this person at lending, like borrowing money? The higher the score, obviously, the better, which we'll talk about more in depth at the end of this video anyway. But the higher the better, and the better they see you as, they give you more money, or they might give you the same amount of money but with lower interest rates, or they might give you the same amount of money with the same interest rates but like a longer time to pay it back or a shorter time to pay it back, or they give you all this other stuff just because they think you are better at paying stuff than others. And again, a mortgage won't mean much to a first year or a second year, but maybe in your third year, once you graduated, even if it's not a mortgage, a rent, you might be looking at these other things like rent or just loans, again, credit cards, first car. All these things are important. Maybe not right now, but they will be very soon. And the quicker you start, not even the quicker you start, the better, but literally like you have to start now. Many of us have to start now because it takes a while to grow your score. And if you start when you need it, it's going to be too late. So with that out of the way, let's actually talk about what your score consists of. And finally, at the end of this video, talk about how you can improve that. So what is your credit report first? And then what does it consist of? So your credit report is not the same as your credit score. That's the first thing that I got to get across in this part of the video, because many people think that your score is it. If you got a good score, you win. But your score, this thing is an arbitrary statistical, variant of this thing, which is your credit report. And the difficulty here, which we'll talk about more later on, is that every lender, every bank, every bureau uses this report differently. Your report is the same everywhere you go. It's like Jordan has this, that, the other. I mean, I'll talk about what it consists of in a moment, but it's the same everywhere. But what is different, what differs everywhere, is like how they interpret these data points and then what score you get at the end of it. So don't pay too much attention to your score. Your score is kind of like just a number, an arbitrary number that you can use for educational purposes only. It's not actually indicative of like how well your report is fundamentally. But then let's actually talk about again what this credit report is made out of. And it's interesting that I put 5 things up because it literally is made of 5 fundamental attributes. So what are the 5 attributes? So the 5 things that make up your credit report are your payment history, which is the most important, your credit history, which is the least important, your credit utilization, which is here as well. You have the third thing is your credit types, and the fourth thing is your credit inquiries. The last thing again is credit history. These all account for 100% of your score, but not all of them are weighted fairly. They're not all weighted equally. So payment history is the first one. That's worth 35%. That's like almost half of your credit report is based on this one thing. And the second thing, your credit utilization, is 30%. So just these two, your payment history and your credit utilization, account for 65%. That's more than half of your credit report. It's based on just those 2 things. So those are the things we're going to take the most time talking about in this video. But again, very, very big, very, very important parts to consider: your payment history and your credit utilization. The other 3 things, as I mentioned, are your credit types, which is about 15%. You have your inquiry rate, which is about 12 to 15%. And then you have your credit history, which is between 5 and 12%. Typically, I would just say 35, 30, 35 payment history, 30% credit utilization, 15% for credit types, 10% for your inquiries, and then 10%-ish for your credit history, although they all differ everywhere, which again, we'll talk about in a bit more depth later. So the reason why they all kind of differ in percentages is because I mentioned briefly before that every bureau, every lender uses the data differently. Although all 5 points are the same and they all roughly mimic each other, there are some important differences that I don't even know because they don't even disclose it very well. But it's important to recognize that there are differences in that, again, your report isn't the same as your score. So focus more on the report than what your actual score is given. But yeah, that's kind of that. Briefly, before I go into like actually breaking down what these 5 things mean, the 3 credit bureaus are, I'm going to keep mentioning them throughout the video, so it's important that you know what they are before I start. It's like Equifax, TransUnion, and Experian. It doesn't really matter what they do or what they are or whatever. Just understand that they are like the gatekeepers of that information. They send the information that you give to your banks or your lenders, whatever, is given to those bureaus. Not necessarily all 3 of them, but at least one of the 3. And they will generate your report, and then they'll generate a score based on that. But again, the score is not as important. How do they get this information? They get all of your info through the public register, which in the UK is the electoral register, which means electing. Registering to vote is way more important than just, the political side of it. It also has a big impact on your credit report, which is far more important, at least within the 5 to 4 year interim between elections. That's when it's more important. Of course, vote, register to vote, super important, but also credit report is another big reason why you should also register to vote in the UK. They also use other public directories like CCJs if you have any. We shouldn't, as students, have a CCJ. It stands for a county court judgment. That's very bad if you get one. So don't worry about it now, but that also exists. If you do have a CCJ on your report for whatever reason, dispute that if it's not yours. Obviously, if it is yours, then that's peak. But yeah, dispute any errors on your reports. You can do that by going to the bureau's website. Again, that's Equifax, TransUnion, or Experian. Go to any of those websites and then deal with your report from them. But that's all for you to deal with after this video. So now I've kind of explained, I guess, all the basics, all the necessary basics of like your credit score, how it works, how all the bureaus work. But let's talk now about the 5 fields and how you can improve each one of those, what they all consist of, and etc. etc. So field number 1 is your payment history, and that, as I said, accounts for 35% of your report. What does that mean? Basically, it means that every time you take out whether a credit card or a loan or a finance, whatever it is, where you have to make monthly repayments, how many months have gone by since the first one where you paid it off in time? Not necessarily in full. You could be paying the minimum, you could be paying an arbitrary amount, you could be paying off in full. But how many times have you been making at least the minimum payment for the number of months that you started taking it out for? That's it. That's basically it. And it sounds simple. To be fair, it's probably the easiest one to explain out of all the other attributes. But it's by far the most important because all these lenders care about when they look at your credit report is like, is Jordan going to pay off this debt? I'm going to lend him so much money, but am I going to get it back? That's what you need to know. And if the data and history suggests that I will pay that back, then 9 times out of 10, they're going to be satisfied with that. Obviously, there are still 4 more reasons, there's still 4 more checks they got to do. That's more so they can actually determine your credit behavior more so than your credit history. But fundamentally, yeah, if you got a good payment history, that's a big part of your score already in the plus. There's no real way to improve that other than by continuing to pay it off and to have a longer history, which we'll talk about in the fifth section, the credit history section. But yeah, that's it. I know I said I was going to talk about this in a bit more depth, but there's actually not much more to talk about when it comes to payment history because, as I said, as long as you're making the payments, you can't do much in between them. Just pay it off. Technically speaking, if you pay off more instead of less, that is going to reflect better on your report. If you're holding a lower balance, that's also going to reflect better on your report. But that speaks more so to the next point of credit utilization than payment history, because payment history, again, is like they look at the number of months passed since you took out the first one and said, have you been making those payments? Yes, cool, green. The only thing to be wary of here, I guess, is the 30-day rule. So if you miss a payment, that's bad, but it's not as bad as missing it for 30 days because once 30 days pass after you missed it, that's when you get a strike on your report. It says like payment missed. Generally, you have up to the 30th day to make that payment. I would always recommend, that anyone should always recommend, to pay it off in full each month before the deadline anyway. So don't even miss the deadline because otherwise you accrue fees. Yeah, you get, they charge you late payment fees if you're late, but it doesn't really matter as far as your report's concerned until it's 30 days late, and then every 30 days thereafter as well. Like if you miss the first 30 days, that's bad. But what's worse than that is missing the next 30 days. That's 60 days late, 90 days late, 120 days late, and like as it goes on, it gets worse and worse and worse. And that's when you start getting CCJs, as I mentioned before, the county court judgments, or you get people coming after you for this money. Not necessarily like a loan shark coming after you, but you still have like bailiffs or whatever, or like send a letter in the post, you get some of those. But we're not going to worry about that because we're going to pay off our debts every month in full without fail. The next thing is credit utilization, and that accounts for 30% of your credit report. And this is something that has a big myth attached to it, which I'm going to clear right now, and that is about your credit balance. People say you've got to keep a balance on it. That's how you keep your report growing. That is a complete myth. That's a complete lie. I actually think some of these bureaus made that up just so they can charge you more interest for keeping it balanced. That's a lie. What you need to do is keep your card active, and what that means is every now and then spend some money on it, but there's no reason to keep it balanced. If you just every month you spend £1.50 on like a pack of chewing gum, or you spend like £40 filling up a tank of petrol, and that's it, that's fine. And as long as you paid it off, again, that's doubly fine. But the myth that you need to keep money on your card at all times is complete bollocks. Don't fall for it, because you end up paying off all these fees that you just don't want to be paying in the long run. Specifically on the point of your credit utilization though, they say a good balance, a good range is to use less than or up to 30% of your credit utilization, your credit limit. What does that mean? That means if you have one credit card with like £1,000 limit on there, you shouldn't be spending any more than like 30 quid, or 300 quid, sorry, because any more than that just reflects badly on you. And it's like, why is this person, like, granted, you might have a high limit, but why are you using so much? Are you struggling? Are you going to continue to make these payments? Maybe you're using so much right now because you're going through a lot, and there's no telling if that's going to improve the following months or get worse or stay the same. So make sure you're using about 30% each month, if not less. Not so bad range is 50%. Bad, and then obviously very bad, would be 70% plus. If you're using more than 70% and even more, that's very, very bad. That doesn't reflect very well on you at all. But it is important, again, to try and keep it below 30%, or at worst case below 50%, and then that will positively affect your score by about 30% weighting. One thing to know, I guess, this kind of applies to everything in general, but when it comes to improving your score, what you want to show the credit kings, in short term at least, is that you're changing. Like, everything in life is about change, I guess, to some degree. You can be paying off the payments every month forever, but if it always looks the same, your report's not going to go anywhere. But if suddenly you make a fat payment, or you clear off some old debts, or you drop your utilization from 70 to 30, the kings of credit are going to look down at you and see that and say, okay, this person's getting their stuff together. They're sorting out what they got to sort out, and that's going to affect your score quite a lot in the short term. However, long-term results, I mean, it will also affect the score in the long term, but in general, for the credit report generally improves over a long period of time, not just in 30 days. So you can do some instantaneous changes that will reflect positively on you in short space of time. But generally, all these things, again, like payment history, you can't improve that without making the consistent payments over time. So it's all a long game, which is why, again, I say to start now instead of once you graduate, because then at least if you start now, you have a good enough score to have a good enough rates in the future. Whereas if you start in the future, you have literally no score, no history, no nothing, and it's going to be hard to get that in a short space of time if you're trying to move out quickly once you graduate. So bear that in mind moving forward. And I guess from everything I said, over the last 27 minutes. So next on the list is your credit types. That accounts for, again, 15% of your credit score. And this is basically just, is it a credit card? Is it a loan? Is it a finance? And that's it. The important takeaway from this is that your bills and your rent and your subscriptions, they don't count. The banks don't care if you've been paying gym membership every month for 20 years. That doesn't matter to them. All they care about is, have you got a credit card, or have you been paying it? Have you taken out a loan? Have you been paying it back? Have you got a finance for, your phone, your car finance, whatever? How have you been paying it? And again, car finance is important because it's not your insurance, it's your car. If you're buying the car on finance, that counts. If you're paying for insurance each month, that doesn't count. So remember, try and think about whether or not you've borrowed something from someone, and then whether or not you're paying them back for what you borrowed, or whether you're just paying them back because it's a service. Like, you're paying for insurance as a service, not necessarily as they gave you something and you're getting something back out of it. Insurance, like, if things go wrong, whereas with a car finance, you actually get the car for free basically, and you pay back, well, for the deposit, and then you pay back the rest over time. So that's an important difference to recognize. In the UK, your bills do kind of count because, as I said, all the information they get is from the public register, and they can see your accounts, your bank accounts, your phone contracts. They can see that on the public files, but it doesn't have a substantial effect on your score. Sometimes it does. Like, I guess if you're in a, because I said it comes from your electoral register. If you're in a relatively bad area, the area itself won't affect your score, but the data you get from that is like, okay, this person's in an area of like where things generally aren't so good. So that might in turn, your area itself isn't the problem, but what the area, but that area being on your data file might do something to you. I don't know. I couldn't find the obvious consensus here. I don't think that's the case. That'd be quite unfair, but it's worth recognizing that these things don't actually count. However, they might a bit. So bear that in mind. The next one is your credit inquiries or your credit searches. That accounts for 10%-ish. And what that basically means is, like, have you been trying to or making applications, applying for credit? Generally speaking, it doesn't matter as much as, again, I said, it's 10%. However, you do want to avoid making too many hard searches in a short space of time. Your inquiries are split into soft and hard searches. So I just mentioned hard. Soft is basically like they kind of look, like they glance through your report. It has no impact on your score whatsoever, which is another myth as well. People say that if you check your credit report, that affects your score. That's a complete myth. It doesn't affect your score at all. It's also free basically everywhere you go. You can do it through the bureau websites, again, through Equifax, Experian, or TransUnion. You can go to the websites and make an account and check your credit report and your credit score. Or I have an app. I've got two apps. I've got Credit Karma and I've got ClearScore apps. So ClearScore One app is called, and that gives me my credit report for free every month in full, and that's just way easier. It has no effect on your score. Again, bust that myth. So just make sure you're checking it. Make sure you're aware of what's going on. And again, your score and your report are two different things. So make sure you're checking your report and not just your score, because that will be way more indicative of like how you're doing and how the bank see you. So again, the soft search is like a glance where they kind of look over it and just see like the basics. It has no effect on your score. But a hard search now is when like Toyota or whatever or Apple actually asks the bureau or someone, say, look, can I see the full report? And then they actually look through it in depth. And if they're looking through it in depth, that's when it shows up on your report, and that's when it affects your score negatively regardless. However, it'll be even more negative if you get rejected, because that shows that they don't like what they see. Which is why it's bad to make so many applications in a short space of time. If you make loads in like a short spell and they all get accepted, that looks okay because they've been accepted, but at the same time it's like, why have you been applying to so much stuff in a short space of time? Are you in a position of need? Are you struggling right now? Is that why you make so many applications? And that obviously reflects badly on you if you're seen as like greedy or something. What they always say is like 1 or 2 at most within a year spell. So I try and do like every 6 months, or at least 6 months I'll apply. If I've got to apply for something, like I know I want to get a new car in September, so once it gets to February, hopefully I don't need anything right now anyway, but once it gets to Feb or March, I'm not going to apply for anything else. I'm not going to risk damaging my report for the future, because as I said, I want to get a car come January, so I'm going to be come September, sorry. So it's about being aware of like when you need credit, and then what are you doing in interim before making that effect, because 10% doesn't seem like a lot. It's not like a massive impact. But those tight margins are important when you're my age and when you're a student, because we haven't really got a great score of like big history. It's like I've got 3 years on me. And granted, the 3 perfect years is still only 3 years, so that could be a big difference in the grand scheme of things. So I've got to be careful, and most people our age also do have to be careful. The last thing is your credit history, and basically there's not much to say on it because we're all young, we're all like 18, 19, 20, up to 25. I've seen my demographics on YouTube and analytics, so shout out to all you lot who are 25 plus, which is like one person. But basically, your credit history is like your credit history. How long have you had a credit report for? How long have you had credit cards, loans, finances, whatever for? That's it. Have you had, if you have, the idea is you want to have 5 to 10 years. Obviously, the longer the better, but 5 to 10 years is kind of like the good range. There's no way I can possibly have 5 to 10 years. I'm 22 years old. The best I can do is 5 years when I turn 23 in June. So that'll be interesting. But before then, there's nothing. There's not much we can do about that other than just starting early. Again, start as early as you can. Get a credit card as early as you can, as long as you're sensible with it. And then that will keep your score. That will start your score off, and then it will continue to grow from then. Again, if you're sensible and you're making those payments on time, because payment history and credit history are basically, they're not literally the same, because your credit history is like how long have you had it. That's it. The payment history is like how long have you been making those payments. But together, you need to have length. Longevity. These things come from longevity. And without longevity, you don't have either of those, which is what 45% of your report, up to 50% of your report comes from just those two things, just having one and paying off each time. So bear that in mind. That's essentially what I've got to say for this video. It is important to note, I guess, on the last point, the credit history point, that long term, yes, it's important to have a longer credit history. However, it's 10%. It's not as big a deal as you think. Obviously, payment history is aligned with that, and that is obviously very, very important. It's 35%. But if you have a short credit history, like people, actually, that's a good intro to this myth as well. Because people often say you should close your old accounts if they're old, not doing anything. If you do close your old accounts, if your first ever credit card was when you were 18, you're like 28 now, and you don't even use that much anymore because maybe it's like a credit builder, you don't need it as much, you might think to close that. But if you do close that, you're not only losing your utilization that you have on that account, wherever your credit limit is, but you're also knocking off like 10 years of perfect history on that card just for the sake of like ease. I mean, to some degree, if your score is really great, again, 10 years or 10%, sorry, isn't that substantial as long as your other numbers are doing well. But it's important to recognize that, again, keeping old accounts might be important. And even if you are still young, like if you're my age, I haven't really got an old account to keep, but it makes me think more. For example, my overdraft, my student overdraft, got that when I was 18. That's 4 years. If I get rid of that Santander account now, I'm going to lose 4 years worth of data. And again, 10% isn't as substantial, but those payments each month are substantial. So it's about thinking about, as I said again, think about it early. What are you going to do? How is this going to affect me in the long run? And how is that going to affect my report and then in turn my score? And yeah, that's basically it. If you have any more questions, obviously let me know down below in the comments. One thing that I did miss out that I feel compelled to mention now, I don't really want to talk about it in depth because I haven't got the account myself, but I've seen it around a lot and I understand what they do, and it's very beneficial to some people out there who might not want a credit card per se or like a loan per se, but still want to focus on their score. So this is for you guys. But there's a service called Lockbox. It's Lockbox. I'll put a link in the description down below. How they work basically is you build like a budget between like 20. Well, you find out on yourself, on your own. Like you determine to yourself how much money can you afford to save each month for a year. Between 20 and £200. Let's just say you're in the bottom bracket. You can only afford to save £20 a month. You go to Lockbox with that money and you say, hey, look, for the next 12 months, I'm going to save £20 a month, £20, £40. What can you do for me? They will now give you an account on Lockbox. They'll give you a £240 loan because that's what you asked for, so you can save that money per month. So £240. They'll take that loan out, put it in your account, and it will just say like Lockbox account, minus 240, and then every month is 0% finance, so it doesn't go up. Every month you pay that off. At the end of the year, they put that money into another account that you can take out in cash. Vibes, basically. Vibes is free. It costs you nothing. It costs them nothing. You benefit from improving your score because the credit kings will see you took out a loan and you paid it off in full in the course of the year. Lockbox, they get some money because they opened that other account that they put the money into that you can take out. So they get money from them. The credit kings will look at your report and say, okay, good, nice things. Everyone wins, and it costs you nothing. So it's worth looking into. I myself don't have it. I didn't want to talk about it as much because, as I said, I don't have it. But I do want to say the reason why I didn't get it is because it literally is just you make an account and you put the money in there and you get it back a year later. In the meantime, that money is not doing you anything. I mean, yes, it's growing your credit score, but also so is having the credit cards, which I have, so is having a loan, which I have. Like I don't need to. So also having the finances, which I have, so I don't need it. But again, if you don't trust yourself with money, or you don't want to get a credit card or a loan, this is a good option. It's going to affect your credit score positively. It's a good thing to do, but it's not going to be as substantial as, again, a credit card or an actual. Or to be fair, it's basically a loan, but a credit card is way more influential, I think. And more importantly, again, watch the video on it on credit cards. But there are so many benefits to actually taking out a credit card, or a loan is literally just having cash. The benefits that you have with the cash. But a credit card, again, you get consumer protection, you get rewards, cashback, whatever. Whereas Lockbox is just, you get a better credit score at the end of it. So yeah, it's up to you. I mean, I wouldn't recommend it if you're disciplined and you're sensible and you know what you're doing with your money, you're a responsible lender. Then of course do things the traditional way. But if you don't trust yourself, or if you're quite young, or you haven't really got the money to make these payments off each month, if you are going to use a credit card, whatever, or if you take out a loan, for example, then Lockbox is a good shout as well. And yeah, that's it for this video. So I hope you guys have enjoyed it. Don't forget to message me down below in the comments, or if you have any questions, my Instagram is in the description. Everything's out there. I always respond to everyone, so do that. Like the video if you enjoyed it, and I will talk to you guys in the next one. Peace.